Hello friends, this is your host Rakesh Kumar. In the previous video, we had discussed about the falling wedge as a reversal pattern, and we had also seen a few examples from the real market in the succeeding video. In the present video, we are going to see the other pattern, which is inverse of the falling wedge, which is a rising wedge, and we'll see how to trade this pattern in the real world. Now before we start, I just want to remind you that if you have not subscribed to this channel, then you can do it now to get the notifications of the latest video uploads. And if you find this video useful for you, then please consider pressing the like button, which is there below the video.
But before we begin, let us have a look at the risk disclaimer. It states that the futures, stocks and the options trading involve substantial amount of risk. Your capital is at risk, the losses can exceed the investment. The information is provided as is, and the user of the information assumes the entire risk of any use it may make or permit to be made. So let's get started.
Alright friends, in the present video we are going to see the rising wedge as a reversal pattern. Well friends, for a rising wedge to act as a reversal pattern, we need a few things for the rising wedge to form. Now let us see what are those few things. First thing that we need for the rising wedge is a trend. Well, for a rising wedge we need first I should tell you that the rising wedge is a bearish pattern. So if it forms a reversal, that means the trend should be uptrend, so that whenever reversal occurs, the rising wedge is matured and the breakout happens. So in order to draw a hypothetical rising wedge, what we need is we need to get this polyline, and then we will have to create higher highs and higher lows. I hope this is sufficient. Now what are here? Now this is a high, this one is a higher high, this one is even the higher high. So if we say that this here is the low, then this one becomes higher low. Okay, and this one becomes even the higher low. Now this is a trend in force. Well, we got it. Now which trend is this? This is clearly an uptrend. So for rising wedge to act as a reversal pattern, we need an uptrend. Okay, how we calculated that this is an uptrend? Because it is making higher highs and higher lows. Now we will join the highs Of course, in an uptrend we join the lows actually, so we will join the lows. Okay, this part we have already studied. So we are joining, because this is hypothetical, so we can move the low to the line. So lows, when we join these lows, trend line is formed, and for wedge to be made, for the wedge to make, we have to join the highs also. When we join the highs and we join the lows, you see a conical shape is formed. It is the shape of a cone here, like this. So now this is a formation of a wedge. This looks like a wedge. Now in this wedge, how we have to trade is that the price tends to move within the wedge, and after maturity or after a certain time near this apex, this place is known as apex. The place where the two trend lines meet is called apex. So this is apex. Now near the apex, when this pattern breaks to the downside, then it is called a breakout. Okay, before anything happens, we will see what all things are required. We need a trend and we need an upper resistance line. Well, we got this upper resistance line. You want me to write? I will write it for you. Upper resistance line. Then we have lower support line. Okay, the line which is below the price is a support line, and the line which is above the price is a resistance line. So we have an upper resistance line and a lower support line here. Now when this lower support line is broken, that is called as breakout. Okay, now this price contraction is also a must thing. I will tell you about that also, thanks to the presentation, that we will not forget this. Now there is a need of price contraction. In case the price would have not contracted, then what could have happened? The price could have moved like this. There was a possibility that the price can always go in the channel also. Then it is called a channel formation. We have already discussed the price channels. So this will be a channel formation in that case, and this will be a channel breakout. But no, when the highs are contracting or the highs are not giving good reaction, then they tend to contract and come close to the lows. Now see, the higher lows are in the same pattern, but the higher highs are forming with the less bullish bias, or you can say that the bullish bias is decreasing as the time is going by. So in this case, when it breaks on the lower side here, this is called as a breakout. So this is called breakout. Now after this breakout is confirmed, generally this breakout confirms after the 3 candles on the time frame that you are trading. On the daily it will be 3 days outside this. After this, when the price goes to retest this broken support line as the resistance, sometimes it keep going like this, okay, and then eventually go to the apex and then go down. Now this is one scenario. The other scenario is that the price will go straight to the apex. Okay, this can also happen, that the price will straight go to the apex. That is another scenario. Now in that scenario also you have to wait for a retest. If not the apex, at least the price should retest this broken support line like this and then break below this level, then break below this reaction low which it had formed. Now see, the price was making higher lows, and then eventually when it made a lower low here, and then after when it breaks this low after retesting this level here, that is a very conservative method of opening the position. And I mean, you can open a sell around here after the break. Otherwise, how I trade this pattern is that I open a sell positions at the retest. I speculate that the market will not move higher than this high upper resistance line, okay, and I tend to keep a stop loss above this line, and my take profit target actually in this market, in the shell retest we have seen, there are no definite targets in this pattern. There are no measurable targets, I must say, in this pattern. Why? Because when the pattern starts moving in the reverse direction, you have multiple supports on the way. These multiple supports are this previous low. This will now act as a support for the price because it was a resistance in the past, then it became support. Now you see, previous highs are basically the zones of resistance, and then they become the zones of support. If I make a horizontal line here, then you can see that the price will find support next time it comes to this level, this low, and again it will find some support when it goes to this level here. So the idea is you have to be conservative and keep an eye on how the price reacts to these lows here. Sometimes what happens that the people keep on holding their positions in a hope that the price will go high. Those who have bought here, they may keep holding their positions in order to reap the benefits later on. But if the sellers overpower them and they close below this low, then their stop losses, which are eventually below this level, will get triggered, and there will be a short squeezing, long squeezing, and the price will tend to go rapidly on the lower side and will fetch the next low, and even after that next low. So you have to keep an eye on how the price action is at the lows, so that you can get a good risk to reward ratio. In any case, when you sell it at this place, you will definitely get a very good risk to reward ratio, because your stop loss is very close and your take profit targets are much lower. I hope you got the idea how to trade this rising wedge. I will explain this with examples from the real market in the following video. Till then, goodbye, take care, and keep ripping these green pips.